The greatest profits in speculative history were often made not by acting, but by waiting. Jesse Livermore, the legendary speculator, understood that constant activity is the enemy of substantial wealth creation in the market. He defined the perfect trade setup as a situation where the probability of success is overwhelmingly high, demanding profound patience rather than ceaseless engagement. Livermore's core thesis was that the largest gains came from sitting still, allowing the market to definitively prove the setup before committing valuable capital. This strategy required discipline and a preparatory framework to ensure that when action was finally taken, it was decisive and highly leveraged for success. We are introducing the 3 critical preparatory rules Livermore rigorously followed before executing any major market campaign. Before we delve into these profound lessons on discipline and timing, please take a moment to subscribe to this channel. Subscribing and leaving a quick comment, even if it is just a single word, greatly assists the algorithm in recommending this video to more people. This simple action shows me that this specialized content truly matters to you and is worth the extensive effort required for its creation. Furthermore, please return to this channel during those challenging times when your trading becomes difficult and your confidence inevitably begins to waver. Livermore viewed the market not as a machine requiring constant inputs, but as a vast landscape of opportunities that only reveal themselves clearly at specific, rare junctures. He believed that the vast majority of traders failed because they confused movement with opportunity, constantly trying to force profits from indifferent market conditions. The period of waiting was not downtime. It was the most critical phase of the entire trading process, where observation and planning solidified the foundation for future success. This disciplined inactivity distinguished the professional speculator from the amateur gambler, who always feels the compulsion to be in motion. Livermore's methodology was built around preparation, ensuring that the market and not his own impatience dictated the timing of his trades. The perfect setup, therefore, was not merely a technical pattern, but a confluence of macro conditions, price action, and psychological readiness. He taught that successful speculation is an art of timing, and the timing is only right when all external factors align perfectly with the internal analysis. This strict adherence to waiting for complete alignment prevented unnecessary losses and conserved the mental energy required for high-stakes execution. The 3 rules we will explore govern this waiting process entirely, transforming the speculator's mindset from reactive to proactive and patient. They are designed to filter out the noise and isolate those high-probability moments that offer maximum reward for minimum risk exposure. Livermore understood that capital preservation during periods of uncertainty was just as important as aggressive deployment during confirmed trends. By mastering these rules, a trader learns to accept that doing nothing is often the most profitable action they can take. Livermore's first and most fundamental rule was the confirmation of the line of least resistance, which serves as the trend prerequisite for any viable trade setup. The line of least resistance defines the path the stock or commodity is most likely to follow, determined by the overwhelming structural forces of the market. A trade setup, no matter how appealing it looks technically, is entirely irrelevant unless it aligns absolutely with this major underlying trend. Livermore famously stated that trying to trade against the line of least resistance was like trying to stop an avalanche with your bare hands, a futile and costly exercise. The necessity of using general conditions to confirm the major trend direction was paramount in Livermore's research method. General conditions encompass the macro environment, the overall health of the economy, and the specific strength or weakness of the sector the stock belongs to. He would use market averages, like the leading indices of his time, to gauge whether the primary force was bullish up or bearish down. He insisted on waiting until the market had clearly declared its direction, rejecting any setup that operated against the primary flow or during periods of high uncertainty where the trend was choppy or undefined. The rule demands that the speculator waits until the major trend is undeniable, established by weeks or months of consistent movement. This confirmation prevents the trader from becoming involved in minor counter-trend rallies or dips that ultimately revert to the main direction. Livermore knew that the path of least resistance acted as a powerful current, making trades aligned with it far easier to manage and significantly more profitable. He was not interested in catching the exact bottom or top, but in riding the sustained middle portion of the confirmed move. He applied this rule with ruthless discipline, recognizing that impatience often led traders to assume a trend had started before the market truly confirmed it. Livermore advised observing the market's action day after day, noting how stocks reacted to news and external events. If good news failed to lift prices or bad news failed to depress them, it suggested the underlying trend might be shifting, but he would wait for the unequivocal confirmation before acting. This methodical approach ensured that his trades were based on objective market reality, not subjective hope or premature analysis. The specific Livermore principle that underpins this rule is, never try to fight the tape. The tape, the record of transactions, represents the collective wisdom and pressure of the market, and fighting it is a guaranteed route to financial ruin. Waiting for the market to confirm your bias means letting the price action speak for itself, rather than attempting to impose your preconceived notions onto the underlying reality. If the tape indicated a decline, even if his fundamental analysis suggested otherwise, Livermore would stand aside until the price action reversed and confirmed his view. This confirmation process required him to analyze various market behaviors that signaled the true line of least resistance. For instance, he looked for coordinated movement across multiple sectors, indicating a broad market consensus rather than isolated strength in a single stock. He understood that a genuine trend is pervasive, pulling most stocks in its direction, while market noise or manipulation tends to be localized and temporary. The time spent analyzing these general conditions was considered the most valuable labor a speculator could undertake. The practical application of Rule 1 is the rejection of ambiguity. If the market is moving sideways in a narrow range for an extended period, the line of least resistance is not clearly established, and therefore, no significant capital should be committed. Livermore taught that uncertainty is the market's way of telling the trader to stay out and wait for clarity. Entering trades during periods of consolidation often results in whipsaws where small losses accumulate rapidly, eroding capital and confidence. Furthermore, confirmation of the line of least resistance means assessing the relative strength of the stock against its sector and the broader market. A stock moving up in a weak sector or a stock falling in a robust bull market is signaling resistance, not ease. Livermore sought setups where the individual stock was moving effortlessly, carried along by the powerful current of the overall trend. This synergy between the micro and the macro environment was the true signal that the line of least resistance was clearly established and ready to be exploited. The psychological discipline involved in Rule 1 is immense, forcing the trader to overcome the urge to predict the future. Livermore insisted that prediction was futile and that the successful trader must instead become a follower of the trend once it is established, not a prophet trying to call its beginning. This passive observation, waiting for the market to declare itself, is the first and hardest step in mastering the art of profitable waiting. Only when the direction is confirmed beyond reasonable doubt does the trader move on to the next rule for pinpointing the exact entry. This methodology of waiting for the line of least resistance to confirm itself shares profound similarities with the structural market analysis popularized by Richard Wyckoff. Wyckoff, like Livermore, focused intensely on identifying the large accumulation and distribution cycles driven by institutional money, recognizing that these cycles set the primary trend. If you find value in understanding Livermore's systematic approach to trend identification, you will certainly benefit from exploring the Wyckoff methodology in greater detail. We highly recommend checking out the Richard Wyckoff Trading Methods channel, which offers deep dives into accumulation and distribution cycles, providing a robust framework for identifying when the market is truly ready to move. Learning these structural concepts will dramatically improve your ability to confirm the line of least resistance, so be sure to check out the channel link provided in the description below. Once Rule 1, the confirmation of the line of least resistance, is satisfied, the trader must then address Rule 2, pinpointing the critical pivot point. The pivot point is a specific predetermined price level that, once cleanly broken, confirms the continuation of the trend and eliminates the final elements of doubt regarding the direction. This point is not merely a random resistance level. It is the price barrier that, when surpassed, signals that the market forces have definitively aligned in the desired direction, triggering fresh momentum. Livermore considered the pivot point the exact moment when the setup transitioned from a theoretical possibility to an active high-probability event. The definition of the pivot point is crucial. It must be a price level that has historically represented a significant barrier to movement, such as a major high or low from a previous market campaign. Livermore focused on these pivotal levels because their decisive break indicated that the opposing force, bears in a breakout, bulls in a breakdown, had exhausted their resources. The successful crossing of this threshold acts as a major psychological trigger for the rest of the market, often leading to a rapid influx of follow-through buying or selling. Waiting for this specific price action is the core of the Livermore entry strategy. The waiting strategy here is highly specific, waiting for the price action to cleanly and decisively break the pivot point. Livermore stressed that the entry should occur after the break has been established, never in anticipation of it. Entering before the break is highly risky, as it exposes the trader to the possibility of a false move, where the price touches the level only to immediately reverse. He believed that patience at the pivot point saved the most money, as it allowed the market to prove the momentum was genuine before capital was risked. The importance of price confirmation at the pivot point cannot be overstated, demanding the rejection of trades where the price hesitates or fails to decisively move past the critical level. A stock that merely touches a high and retreats, or one that hovers just above the pivot without conviction, indicates that the setup is premature or potentially false. Livermore sought momentum and certainty. The stock needed to move through the pivot with speed and volume, confirming that significant market players were committed to the new direction. This decisive move is the definitive signal that the waiting period is over. Application detail requires the speculator to wait for the setup to become active by demonstrating genuine momentum at the pivot point, rather than entering based on guesswork near the level. This is where many amateur traders fail, entering too early out of fear of missing the move, only to be stopped out by a minor retreat before the true breakout occurs. Livermore was willing to sacrifice the first small percentage of the move in exchange for the certainty that the move was indeed underway and confirmed. He sought the safety and conviction that came only from trading after the pivot had been conquered. Livermore also used the pivot point concept dynamically, recognizing that as the market moved, new, smaller pivot points would emerge within the established trend. While the initial major pivot point confirmed the primary entry, subsequent minor pivots provided opportunities for scaling into the position or re-entering after minor pullbacks. However, the fundamental rule remained: never act until the price action confirms the pivot has been broken, demonstrating renewed momentum in the direction of the line of least resistance. This rigorous approach minimized the chance of being caught in temporary reversals. The psychological benefit of waiting for the pivot point is that it provides an immediate and objective validation of the trade thesis. If the price breaks the pivot, the trader is validated. If it fails to break or retreats sharply, the thesis is invalidated and the trade is avoided. This clarity removes emotional ambiguity from the decision-making process, ensuring that entries are based on verifiable market evidence rather than internal hope. The pivot point thus acts as a precise filter separating high-probability entries from speculative gambles. Livermore's study of market behavior taught him that prices often tend to gravitate towards the path of least resistance, but they require a catalyst to break free from inertia. The pivot point acts as that catalyst, the specific trigger that releases pent-up energy and initiates the explosive phase of the move. By waiting for this exact moment, the speculator ensures they are entering precisely when the kinetic energy of the trend is at its highest, maximizing the profit potential of the initial move. This strategic waiting is the essence of his trading genius. The final rule, Rule 3, is not about market mechanics, but about psychological fortitude, the virtue of patience and preservation of capital, defining the ideal waiting state. This rule recognizes that the bulk of a successful trader's time must be spent waiting, not trading, and focuses on the internal discipline required for Rules 1 and 2 to align perfectly. Livermore estimated that a successful speculator might spend 90% of their time observing and waiting, and only 10% actually executing trades. This vast period of inactivity is where the true profit is secured. The principle of inactivity requires the trader to resist the compulsion to be constantly involved, understanding that capital is best preserved by remaining liquid during uncertain times. Livermore viewed capital preservation as the primary goal during the waiting state. If you do not lose money waiting for the perfect setup, you maximize the amount available when the setup finally arrives. Boredom is the greatest enemy of the speculator, leading to impulsive, low-probability trades entered simply to satisfy the need for action. This rule demands the trader wait until the setup is 90% right, meaning the confluence of the trend, Rule 1, and the entry signal, Rule 2, must offer an extremely high confidence level. Any trade entered before this high confidence threshold risks unnecessary capital depletion on setups that are still ambiguous or unconfirmed. Livermore understood that even a string of small, unnecessary losses can severely damage both the capital base and the psychological resilience needed for the major campaigns. The 90% rule is a commitment to extreme selectivity. The story of Livermore's great campaign beautifully illustrates the necessity of this long-term waiting strategy. He often waited for months or even years for the right combination of macro market conditions and individual stock behavior to align perfectly before committing significant resources. For example, his famous shorting campaigns required waiting for prolonged periods of unsustainable speculation, followed by clear signs that the line of least resistance had shifted downward before he initiated his massive trades. This patience, spanning long periods of market gyrations, ultimately generated his largest profits. Livermore recognized that the market is designed to tempt the impatient, offering endless minor movements that distract from the major meaningful moves. The practical method for adhering to Rule 3 involves maintaining a clear, pre-analyzed trading plan and refusing to stray from it simply because of boredom or the fear of missing out, FOMO. The plan must define the line of least resistance, identify the exact pivot point, and mandate total inactivity until both conditions are met. Sticking to the plan transforms the psychological challenge of waiting into a strategic advantage. The preservation of capital is inextricably linked to the preservation of mental clarity. When a trader is constantly in the market, taking small losses and managing conflicting positions, their judgment becomes clouded and reactive. By remaining inactive and observing from the sidelines, Livermore maintained an objective, detached perspective, allowing him to clearly identify the crucial turning points when they finally emerged. The waiting state is thus a state of strategic readiness, not passive idleness. Livermore further emphasized that the capital required for a major campaign must be entirely free and uncommitted. If capital is tied up in mediocre trades, the opportunity to enter the truly perfect setup decisively is lost. Therefore, the waiting state is also a state of liquidity, ensuring that when the 90% right setup appears, the trader can strike with maximum conviction and size. This discipline of maintaining liquidity is a foundational element of professional speculation. The psychological battle against FOMO is perhaps the hardest aspect of Rule 3. Livermore acknowledged the painful experience of watching a stock move strongly without him, but he preferred the pain of missing a move to the guaranteed pain of premature entry and loss. He taught that there will always be another great campaign, another perfect setup, but capital, once lost, is difficult to recover, and emotional confidence is even harder to restore. Therefore, preservation of capital must always override the fear of missing a temporary profit. The virtue of patience, in Livermore's view, was not merely a passive trait, but an aggressive, strategic weapon. It allowed him to enter the market at the most opportune moment, maximizing the distance the stock would run in his favor before encountering serious resistance. By waiting for the highest probability setup, he was effectively leveraging time and discipline against the common impatience of the market crowd. This strategic delay is what separates the huge, life-changing profits from the small, inconsistent skirmishes. Livermore's 3 rules create a unified, systematic approach to market entry that prioritizes certainty over speed. The strategy begins by waiting for the line of least resistance, Rule 1, to definitively confirm the major trend direction, establishing the macro context. It then proceeds to wait for the critical pivot point, Rule 2, to be broken, providing the precise, objective entry signal. Finally, it demands maintaining strategic inactivity and capital preservation, Rule 3, until both preceding conditions align with 90% certainty. Adhering to these 3 rules fundamentally shifts the trader from a constant speculator to a patient opportunist. The outcome of perfect waiting is the minimization of risk exposure by avoiding ambiguous market phases and the maximization of the probability of catching major sustained moves. By delaying entry until the market has proven the path, the speculator ensures their capital is deployed only when the forces of supply and demand are overwhelmingly in their favor. This disciplined approach eliminates the wasteful, choppy trading that destroys most amateur accounts. Livermore's legacy confirms that true success in speculation is not about being right often, but about being massively right when you are finally ready to act. His system teaches that the profit is inherently made in the waiting, in the disciplined observation and preservation of capital, not in the frenetic act of trading itself. By adopting these 3 rules, any serious trader can transform their approach, moving away from constant guesswork and toward highly selective, high-conviction market campaigns. The enduring wisdom of Jesse Livermore's methods is captured perfectly in the classic text detailing his life and strategies. If you wish to fully incorporate the psychological discipline and systematic approach required to implement these 3 rules, deeper study is essential. We strongly recommend the new edition of Reminiscences of a Stock Operator, the timeless classic by Edwin Lefebvre. This edition goes beyond the original narrative, offering deep analysis of Livermore's psychology and strategies, complete with unique commentary and chapter-by-chapter breakdowns that transform his historical experience into practical, actionable lessons for the modern trader. You can find the link to this essential resource right now in the description below.